Hi, we're Matt's on Fire, and today we'll share why we invest in index funds and how doing so has helped us achieve financial independence. Remember to scorch that like button so the YouTube algorithm knows this is useful content, and consider subscribing to our channel. We aim to post new videos weekly. Let me tell you our secret to successful investing. No, we didn't get lucky buying an Amazon, Facebook, or Tesla stock, nor did we get lucky investing in a top-rated Morningstar actively managed fund. Our crystal ball is too cloudy for that. So what did we do instead? We chose a boring index fund. No, seriously, it's boring, and boring is good. This is what billionaire George Soros had to say about investing. If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. What is an index fund? It's a basket of stocks or bonds designed to follow the composition and performance of a financial market index. It's a passive investment strategy that has lower expenses and fees than an actively managed fund. It matches the risk and return of the market based on the assumption that it will outperform any single stock or actively managed fund in the long term. But Matt, you say, investing is so easy and I can do my own research and pick the best individual stocks or funds that will beat the market many times over. Sorry to break the news, but numerous studies have shown that however tempting, it's almost impossible to beat the returns of the market over the long term. According to the SPIVA Scorecard, a widely referenced research piece that compares actively managed funds against their appropriate benchmarks, actively managed funds have historically tended to underperform their benchmarks over short and long-term periods. Even when a majority of actively managed funds in a category have outperformed the benchmark over one time period, they have usually failed to outperform over multiple periods. They have lots of data you can browse, and we'll include a link in the description. Wherever possible, we make decisions based on data and evidence, not anecdotes, since over the long term for the average investor, that provides the best return. There are many other reasons why we prefer index funds over individual stocks or actively managed funds. Here are our top 5. First, it helps us avoid wasting time trying to pick the best stock or stock fund. We don't have to watch or listen to the news to monitor the stock market every day. We just buy at the beginning of every month and hold. That's it. More free time to do more important stuff like watching cat videos. Second, it's well diversified. Why is diversification important? Well, if one sector of stocks fail, you have other sectors or thousands of other stocks to keep you afloat. If your portfolio is limited only to a handful of stocks or a specific sector, you'll be wiped out clean if they crash. The Total Stock Market Index Fund, VTSAX for example, contains 3,525 stocks. The Total International Stock Market Index Fund, VTIIX, contains 7,425 stocks. And the Total Bond Market Index Fund, VBTLX, contains 9,881 bonds. Thousands of securities in just one index fund. Third, it's cheap. VTSAX has a fee of 0.04%. compared to the average fund fee of 1%. That means for a $1 million portfolio, you're paying $400 per year if you invest in VTSAX versus paying $10,000 per year for an actively managed fund. You'll save a ton of money. How much money? $9,600 per year. And if you account for opportunity cost, that is, if you invested the difference, that will cost you about $1,043,378, assuming a 7% growth over 30 years. Fourth, it has low turnover, meaning there's not a lot of buying and selling within the fund. This means there are less capital gains incurred, and most of the dividends are classified as qualified, which receives favorable tax treatment. Overall, having mostly qualified dividends plus a low turnover makes index funds tax efficient. Fifth, it's simple. We love simplicity when it comes to investing because it's easier to implement and maintain, not only by you but for your spouse, caregivers, and heirs. Still not convinced that index funds are right for you? Maybe some words from famous Nobel laureates and investors will help. The most efficient way to diversify a stock portfolio is with a low-fee index fund. Statistically, a broadly based stock index fund will outperform most actively managed equity portfolios. You may think your opinion is superior, but it pays to be humble in investing in the market rather than trying to beat it. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results, after fees and expenses, delivered by the great majority of investment professionals. So there you have it, some convincing reasons why we invest in index funds and why you should too. Evidence and data are your friends. Please help our channel grow by igniting that like button and subscribing to our channel. Also, please check out some helpful links in the description below. Thanks for watching, and see you next week on Matt's on Fire.